Hey everyone, me Kevin here. The market, holy crap, is on an insane roller coaster. It is absolutely mind-boggling. It's stressful. It's anxiety-inducing. It makes you feel like, well, we can't go to a bar, so never mind. This morning, most of us in the market woke up to see, yay, green jobs report. Ooh, yay. By the way, I broke that labor report down in my first video today. You're welcome to check that out. And we're thinking, yay, stocks open up green for like the first 5 minutes. Then the market tanked early morning, and only within the last 2 hours of the day did the market rebound. So what the heck? What the heck is going on, and what can we expect going forward? How do we invest in this kind of market? How do we make money? I mean, after all, how is somebody mentally supposed to survive the fact that Tesla's supposed to go up 70% only within the span of 3 days to fall 27% and then regain 7% back at the end of the day, now being up 3%? What? How is it supposed to be that Zoom goes up 40% in a day and then quickly gives up 25%? How does DocuSign skyrocket 20% but then give back 25%? Folks, this market is irrational. Dare I say, irrationally exuberant, but maybe just taking a break. Now, yesterday I described how a lot of this drama is probably profit-taking at hedge funds and fear because of the Federal Reserve's fear-mongering. I broke that all down in detail, so that might not be a fair representation. But what is very important to know is that when hedge funds take profits so that they can report quarterly profits to their clients, what happens when a hedge fund takes profits? Well, they have more cash in the bank. And what do hedge funds love doing when they got cash? They go shopping again. And that's exactly why we might have seen this late day rebound. Because usually during the midst of this pandemic, anytime we have a 3-day or even longer period of time where the stock market isn't open, people start getting antsy to go shopping again. It's like we can't help ourselves but push these stock values right back up. So what is this? Is this sort of rebalancing sustainable? Well, let's break all of this down into 3 parts. And remember, this video is sponsored by your ability to get 1 free stock with Webull. You deposit $100, they give you 1 free stock worth up to $1,600, totally for free. Helps you with the madness a little bit, link down below, and get life insurance in as little as 5 minutes. It's good to have. We're in a pandemic and they're still issuing life insurance. Think about that. All right, first, this is how we're gonna break this down into these 3 parts. So first, is this market expensive? Then we're going to talk about what's happening, what's causing all this, sort of an update to yesterday's video. Then what can we expect going forward? All right, is this market expensive? Well, it depends on what you're looking at. Let's take a look here and look at some consumer cyclicals. We'll look at some of our favorites here for a moment. You know, consumer cyclicals are like the airlines, the retail, the Disney, and all that good stuff, right? When we look at these stocks, all of these stocks are obviously still down 30 to 35%. Not anywhere near as low as they used to be when they were around 60%. But they're still down 30 to 35% for the year. And when we first look at these sorts of companies and stocks, we think to ourselves, ha, I am a value investor. These companies used to be worth a whole lot more, and now they're not. Well, they're not because, well, A, they're a bankruptcy risk, and B, they're taking on massive amounts of debt. I mean, let's look at some of our favorites here. Disney, folks. Disney took on $11 billion in debt to survive. Carnival Cruise Lines took on $6 billion in debt to survive. The airlines, well, Delta Airlines is the one with the least debt, but it's kind of like picking from the best of the worst. Delta Airlines has so much debt. Fortunately, some of it was given to them via government bailout because can't let the airlines go under. Screw all the small businesses in America, but the airlines got to be okay. And Dave & Buster's, even Mr. Buster's, took on $75 million in new shares. That is, they sold $75 million in shares at $10 a share just to be able to survive this pandemic. And the pandemic is not over yet. And so, yeah, these recovery stocks look cheap. And, you know, jumping into these seems desirable, but really all you're doing is picking up somebody else's interest bill, probably for the next 3 to 5 years. kind of why I keep these stocks at no more than 5 to 10% of my portfolio. Maybe 15% if I was feeling generous in wanting to pay somebody else's interest. Well, when we compare that to tech, we get an entirely different looking market. Here, just look at QQQ. This tracks the NASDAQ 100, which remember NASDAQ likes to track healthcare and mostly technology companies. You got some telecommunications in there as well, but the NASDAQ is, well, let's just look at the chart. It's up 31% from the beginning of the year. The S&P 500 is barely up 5%, and the Dow Jones is down 2% for the year. Why is the QQQ doing so well? Well, because pretty much anything tech right now is absolutely blowing up. In fact, when we zoom out and we go to the 5-year chart, it almost feels like it's an exponential curve. Certainly if we max it out, but hey, we don't have to do that. We don't want to be that offensive to tech. It looks pretty good. I mean, even the fall in March of 2020, right when the pandemic struck, the bottom of the market, March 23rd, and the second bottom of the market, April 3rd. I'll never forget those days, but those look like a little hiccup in history compared to what we've seen for realistically the last, 5.5 months now. And so, initially we look at these two different graphs and we're like, okay, well, the recovery stocks are super cheap. Let's go plow into those. Tech is super over expensive and overvalued. Let's get out of that. In fact, this is a very, very common chart that people keep pulling up on the YouTubes is, price to earnings ratios in the country. This basically goes back to 1880 over here, but I'll just put my face back over that because, who needs that? It's much better to look at, oh wait, no. Okay, maybe we go to blank. We don't want to look at me. I need to get a stimulus check so we can shave again. But anyway, look at these levels here. I mean, we look at probably the average long run price to earnings ratio for the S&P is somewhere around 15 and a half. Look at where we are now, almost double that at 29.6. How does it make any sense that the S&P 500 is trading at a 29 price to earnings ratio? That is historically high, and in many respects, that justifies another pullback in this market. In fact, maybe even a substantially larger pullback in the market, just by looking at that metric. But wait a minute, for us to actually understand what's happening in this market and whether or not those numbers are actually even slightly reasonable, we kind of have to think, wait a minute, what's going on in the market? Like, why would the NASDAQ 100, QQQ be up like 32% when the S&P is barely up and the Dow is down 2%? Well, it's quite simple. The S&P is made up of a lot of companies whose earnings have gone in the toilet, and the NASDAQ is made up of a lot of companies whose earnings have skyrocketed. But in addition to that, we're still seeing stretched valuations in tech. And so where is that extra money coming from? Well, while we don't have all of the data yet, we do have some trends forming. By March of 2020, we had 52% of Americans holding stocks. However, in May, June, July, and August, all brokerages like TD Ameritrade, Robinhood, Schwab, M1 Finance, you name it, reported record growths in brokerage account openings with new customers. That means we're getting millions upon millions of people who have never invested in stocks before, now all of a sudden deciding, you know what Kevin's been saying on this channel for years is right. The people who invest and control assets get wealthier in this country. Everybody else gets left behind and screwed. You own stocks, real estate, business, you win. You don't own those three things, you're paycheck to paycheck, and you get screwed in this country. We get it. But what about money? Well, this pandemic's been very interesting. Our government, in conjunction with the Federal Reserve, created $3 trillion in stimulus money out of thin air. Think about that for a moment. There are 330 million Americans. If we divide 3 trillion by about 330 million people, that's the equivalent of giving every single living soul in this country $9,000. That means my 2-year-old son basically got $9,000 worth of stimulus. Now, how this money gets spread out is obviously, you got to put in politics, which means basically the rich get most of it. Some people got unemployment checks. Some people got stimulus checks. Okay. People who owned real estate got really big stimulus checks because they were able to take mortgage forbearance at the same time as real estate prices popped up like crazy because mortgage rates got cut. So I'm kind of going in order here. Unemployment pays stimulus checks, then you go to real estate. Okay, you got a nice little boost there. Then some people got some nice big fat PPP loans from the government that said, hey, you know what? Don't worry if you have any uncertainty. Here's a ton of money to cover all your payroll. well, if my payroll's covered and I can reopen my business because I'm essential, or at least partially essential, then what am I going to do with all the money I would have normally spent on payroll? Stocks. Yes. The point is, a lot of people got money and used their money, yes, to survive. But from what we're reading and seeing in the research here, gatherings here says that a whole lot of people got a whole lot more money than they needed. And I'm not saying that's bad. I mean, if anything, I'm partially to blame because I keep telling y'all, take mortgage forbearance. It's free freaking money. Like, take the programs that exist, okay? All right, I'm fine. Blame me. But the point is, when we have more cash, we're like, okay, what do we do with it? We're in a pandemic. Are we going to go to the shopping mall? No. How about we just buy some stocks? Which is actually a very smart idea in general. We keep buying in and averaging into the stock market. So a lot of this $3 trillion kind of did end up in the stock market. And thanks to the Fed tanking interest rates, about 1.69 million people, 1.69 million people refinanced homes in the second quarter of 2020 alone. That's up 50% from the first quarter. In fact, we hit a 10-year record in the amount of loans that were conducted in the second quarter ever in this country over the last 10 years. Basically, since property values rose at the same time as people kind of were looking for more opportunities to get cash and rates fell, more people are taking cash out of their properties, and guess what? A lot of that money goes right back into the stock market. So, the fact is, when we consider, wait a minute, where's all this money coming from? When we start looking at the catalysts of this last year compared to other year, it's like, well, there is a whole lot more money in, a lot of people's hands. Not everyone, I don't want to minimize the fact that some people are suffering, and that's very true. There are a lot of people suffering, mostly people without any stocks or real estate. But there are also a lot of people getting in. In fact, take a look at this. This is via Bloomberg Intelligence through the Wall Street Journal. We've got that individual investors, are now making up an approximate 19.5% of trading volume in the United States. We have barely crossed 15% in prior years. These are prior years, not prior months. Every bar is a year. Look at this last decade. People are piling into the stock market more than ever before. And this is individual investors, not hedge funds. Aha. So now we're starting to pull some more pieces of the puzzle together. We got a ton more money. Individual participation is up. People have access to more money through real estate or forbearance programs or whatever. Let's now start connecting the dots. If millions more Americans are buying into stocks and millions more Americans have money to buy the stocks, well, that leaves more people fighting for the same amount of profit from these companies. Remember, all a company is, and a stock is your right to a share of that company's profit. That's it. Well, these companies don't have exponential profits. I mean, some of the newer companies do, okay? But you know what I mean? Like, they don't have infinite profit. And so when more of us have more money to throw at these companies, then what happens is the valuations naturally float up. So when we look at that S&P 500 chart, yeah, some of that data is skewed because some companies' earnings have plummeted, certainly like the recovery stocks, which many of them are in the S&P 500. But when we look at valuations of even tech companies, yeah, some of those earnings and valuations are floating up because people are willing to pay more money for safer, big tech, in anticipation that these companies are going to continue to grow and dominate over the next, instead of maybe 18 months, maybe 4 or 5 years. In fact, there are plenty of people like me who say, look, I'm not worried about Tesla's price to earnings ratio today. I don't care what the earnings ratio is today. I know that Tesla is going to be able to manufacture and deliver 2+ million cars within the next 18 months. And when I start basing my valuations off that, Tesla don't look that expensive. I just have to be willing to wait those 18 months or 3 years or 4 years until those targets come to fruition, or the company just goes bankrupt. But the realistic fact is, right now here in 2020, most of us look at companies like Facebook, Amazon, Apple, Netflix, Google, AMD, Tesla, heck, throw in Zoom and Salesforce, and I don't think any of us think those companies have more than a 1% chance of going bankrupt. So we're all fighting for the same profit, and that drives valuations up. Now, I'm not trying to justify this market run-up. I'm going to give you targets in just a moment. But it does start to sound a little reasonable when we take into account that there's some dude at the Federal Reserve doing this all day long. Brrr! Okay? Like, think about it this way. If somebody's going brrr and spitting money everywhere, I'm just the dude at the side of the field going, look at all these dudes. Everybody's picking up money. Oh, some money floated over here. I'll take that too. Oh, man, everybody's getting some more money. Oh, look, they're all going over to their play stocks. Man, it's getting crowded over on that field over there. We're just trying to zoom out a little bit from what's actually happening. I'm not trying to defend the Fed. I don't think it's good that the Fed is, going nutso over here, and they're trying to have us have faith in their FAIT, right? Their flexible average inflation targeting, FAIT. That's how you pronounce it, but it's spelled FAIT. Anyway, yeah. About that, I guess we'll see. But in the meantime, a lot of us are fleeing to safety in some of these known brands and stocks. Now, some of us invest in hopeful stocks, right? So we've got the safe stocks. Then we've got hopeful stocks. Hopefuls are like, okay, well, what's the next Tesla? How about Nikola? Neo to the moon. Sure, but you're never going to get that same confidence in those companies as you would in, say, Tesla or Microsoft, at least not for the next few years. And that's why the valuations of like Tesla are much higher than maybe a Neo or a Nikola. So we really have three baskets of stocks right now. We have the safe stocks, the more safe, pricey tech companies, no real bankruptcy risk. Then we have the hopeful stocks. Those are companies that have like a 10 to 15% chance of disappearing, just kind of like the normal startup culture where 1 in 8 of them disappears every year, that kind of thing. Again, think Nikola, Neo, and I'm not trying to bag on those companies. I think those companies have great potential. I think both of them are likely to be part of the 80 to 90% survivor group. But who knows? The point is, they're less of a sure thing than the other dudes, right? I think we can all agree with that. And then we have this third basket of stocks called the Untouchables. Or a nicer way to put it, the recovery stocks. metkevin.com/recovery. These high debt companies have like a 20 to 40% chance of going bankrupt if we get another wave of COVID. Like another wave of COVID would kind of be like the straw that breaks the camel's back of the recovery stocks. This is why I don't go crazy heavy onto them, because part of me thinks I'm doing charity by investing in the recovery stocks. Now, I will be fair. I do think there's a good chance of some nice growth as long as we could get this virus under control. But it's not going to take much to send those companies right back down into the toilet. So that brings us to the bottom line. Is the market frothy and does it seem overpriced? Well, it depends. If there's more money in the market and more people investing in the market, then maybe we need to start redefining the standards of valuations, which is bad. I mean, I'm not the dude here trying to say, ooh, Apple price to earnings ratio of 19. Now it's 36. What a bargain. No, not really. I actually don't encourage buying Apple because I think they're a little frothy right now. Even more frothy than Tesla, because Tesla's got way more growth in the books than, in my opinion, Apple does. And at the same time, looking backwards at the charts is probably not the smartest thing to do because we might be falling victim to value traps. And this is exactly why 85% of my investments are in safer tech stocks. The leftover 15% are in hopefuls and untouchables. And so here are my targets to help us through this madness. I'm interested in Google under $1,600. Lemonade, that's gonna be one of those hopefuls, okay? That one's got some share dilution coming. I like the company, I love the mission, a little pricey. It's a small buy under $50, which both of these companies are under $60 and under $50. Don't go heavy on Lemonade. Rocket Mortgage, it's a buy. I love it. Even at $24.50, I'm okay based on this last smashing earnings they had and the expectations for low rates over the rest of this decade. I think I think Rocket Mortgage is a buy. Tesla, I'm in under 400. Once we start crossing 400, which is $2,000 in old school pricing, I'm going to be a little slower on Tesla, but I'm okay sort of buying in as part of my basket. Purple for me, it's a buy under 19. A lot of y'all didn't like my purple video. I tried my best. It seems like when I do these stock videos, I'm better off lumping a bunch of stocks together. Fine, whatever. The balance sheet, the numbers for purple, the valuation on purple, very reasonable. But then again, it's not a tech company. So it's not like you could look at purple and go, oh, look at that puny 15 times earnings ratio. It's a pillow company and a mattress company, right? So it is what it is. Dave & Buster's. This is really only a nibble, in my opinion, until we see earnings next week. Earnings come out on Tuesday, which is when the market opens again. I'm pretty sure it's after hours. So, by Wednesday morning, maybe we could go shopping for Dave & Buster's. Here's what we're looking for, folks. Dave & Buster's needs to take a Main Street loan. If Dave & Buster's takes a Main Street loan from the Federal Reserve, it is a huge buying signal because they're basically screaming to the world, we ain't going bankrupt. Etsy. Decent at 115, 110. Really love it under 100. I kind of hope the downtrend continues a bit. It's a great competitor against Amazon. Think about it. Amazon's your daily goods. eBay's your glorified Craigslist. Etsy is the small business that just went bankrupt on Main Street. Think about it. It's an opportunity. Apple, got to be under 100 for me. I know Apple's above that right now, so can't really buy Apple. I think we're much better off. Honestly, I'd rather buy Tesla where it is now at 415. Pay a tiny little bit of a premium, like a 3% premium over my buy target. That's okay with me. So some of these, again, are targets you can execute on now. Remember, if you lose money, it's your fault, not mine, because I recommend you buy it and then wait. It's kind of like, if you buy one of these things and then it goes red a little bit, because that's usually what happens when I recommend something, well. But over the long run, they tend to do nicely. Again, no guarantees. All you can do is, knock on wood, buy life insurance and get a free stock via the link down below worth up to $1,600 when you deposit $100 with Webull. Thank you so much for watching this entire compilation of basically what the heck is going on in the marketplace according to some dude on YouTube, whom obviously you should value probably very little. I'm just some dude who got lucky. Thank you so much for watching, folks, and we'll see you next time.